All right. Well, why don't we go ahead and get started? Looks like it's just afternoon, so hello to whoever is out there and logged in, and hopefully for anybody who missed it and might be hearing this on a replay, thanks for taking the time to come out and join us and get some market updates. Good news is, looks like the markets have seen a little pop here in the last 2 days. Dow's up about 10.5%, and S&P just over 9%. So certainly a step in the right direction, and looks like that's primarily from some positive news coming out about the slowing of the coronavirus. And we'll continue to monitor everything that's going on and continue to have these calls and give you all as much as we can in terms of timely updates. I know in the last call we spent some time talking about a lot of the different stimulus and all the various packages and programs that the government has put out there. And if anybody's had any follow-up questions from that, please feel free to let us know, as it may or may not impact you in different ways, with either stimulus money or maybe not taking RMDs or some other type of opportunity that we want to look into. So today we also have a guest speaker, and he will be talking a little bit about some of the different things going on in the markets and give his perspective on kind of where we are and what's going on. His name is Carlson, and he is the Associate Managing Director for MFS Investments. Kurt and MFS have been a strong partner of Steinwell for many, many years, and they've always done a really good job providing us good analytical insight into the markets and investments, as well as just being a really good partner overall. Kurt's been with MFS for a really long time, since 1998. He's been a Pittsburgher since 2002, and he has a designation called a Certified Investment Management Analyst from UPenn, which he got in 2005. And he is going to talk a little bit about some of the different things going on in the markets, and I have some slides here to pull up. And if anybody is having any issues viewing the slides on their computer, hopefully you can go onto the replay and see them. I think what's going on here is everybody in the entire country is doing web meetings right now, and we've noticed some connectivity issues in general, and I really think it just has a lot to do with these programs being very, very overloaded. But we'll do our best, and hopefully you'll be able to kind of keep up. So, Kurt, why don't I pass it to you, and I'll let you kind of just jump right into what you'd like to say, and then we'll jump back in when you're done.
Perfect. Hope everybody's doing well. Thank you, Josh. As Josh mentioned, I've known Josh and Melissa now, I think probably since 2005, 2006, so a good long-term relationship with them. I'd be remiss if I didn't say to start off that I hope everybody is safe. I'm working from home like a lot of people are. My wife and kids are here, and it's I think there's actually a silver lining in all of this, that we get to spend more time together. Josh mentioned my background a little bit. I have been doing this for a good number of years now, so this is I've seen my share of volatility along the way. And kind of the topic of this presentation today, 10 principles of long-term investing resilience. I think the most important really there's a lot of important words right in that topic title, but we're not talking about trading, we're talking about investing. And part of successful investing is to think long-term, and is to identify companies that are those that are incredibly resilient, and that's really what my firm has been all about since for a long time. It is not the most normal environment to present in for me. Normally I'm used to looking at people and seeing you all and understanding kind of what you're looking for. But as Josh alluded to, kind of the show must go on. So I'm not going to hit all 10 principles. In fact, what I'll probably do is focus on 3 or 4. And then towards the end, we can talk a bit about maybe what's going on out there and try to help you all kind of see perhaps through the uncertainty. There are a number of slides here. I guess, Josh, why don't you push forward to, and by the way, we do have a PDF, a handout, Josh, that I can also email you guys to forward to people as well. So I'll kind of talk, and I'll talk to the slides, but if you all can't see them, I'll try to articulate them to you. if you go into the, I think the reality is every one of these volatile environments, this one certainly has a degree of uncertainty to it. The spark is always different to a bad market, but they all kind of have an air of similarity to them, and that air of similarity is the lack of control. And certainly this virus is no different. I think everybody wants to say, oh, it's going to end here, it's going to end there, but it's really, really hard to predict stuff like that, and I don't think that is a suitable thesis for investing. So what is a suitable thesis? What can you control? Why don't we talk about change? I'll call it like a tug of war of change versus change. So if you get the presentation at some point and you're looking at it, what you'll see is slide 3 and slide 4 of the presentation talk about kind of the first level of change that I've seen in my career. And I think you would all echo this. And those of you who've heard me talk before, I always talk about this. Slide 3 and slide 4 of the presentation basically talk about the amount of noise in our lives today. I would argue that one of the biggest change that's happened to us as investors in the past 25 years is the amount of information that we are exposed to. And some of that information is good. Much of it is noise. And if you think about it, 24-hour-a-day, 7-day-a-week cable news entertainment, when combined with the creation of the smartphone, creates a really challenging environment for us as investors. And I would argue that actually amplifies the need for what Josh and Melissa do, because what they focus on a lot with you is long-term planning. And to me, that's the best way to get away from the noise, because what matters hasn't changed. What has changed is the amount of noise and hyperbole that we're exposed to on a regular basis. And that's not going away. And if you think about it, your Google search, we're all stranded in our houses right now, so it's particularly hard to avoid the noise. If you go and search something online right now, in most cases, it's not telling you what you need to hear, it's telling you what you want to hear, which is kind of a challenge. We're all kind of living on our own echo chamber of what we want to hear. So that's one side of the tug of war. The other side is, if you look at slide 5, and I'll explain it to you all, wealth accumulation, and for that matter, distribution for those of you who are in retirement, it's changed a lot. So if you're looking at a portfolio in the early, the late 1980s, 2000s, a higher inflationary environment, it was a little easier to solve for your return. If I wanted to get a return of 6 to 8%, you could do that by having an awful lot of money sitting in cash and bonds. And that's what the slide shows you there on slide 5. What's changed, though, is, as you all know, if you buy a CD or you look anywhere today, is interest rates are really low. And on top of that, people are living a lot longer. So you think life expectancy going higher, interest rates going lower, I've got a pile of money that I have to grow into a larger pile of money because I got to maintain that pile of money because I also got to combat inflation. What does that therefore mean? Well, that therefore means that this market that we fixate on, taxes are boring. Inflation's boring. Outliving your money, life expectancy, that's boring. The market, you can look at that all the time. And especially if you're locked in your house, you can really look at it all the time. And the reality is the market is not the challenge. The market is the solution. The challenge is our behavior in it. The biggest destroyer of wealth in America has and will always be human behavior. The change is 24-hour, 7-day-a-week cable news entertainment when combined with a smartphone that makes it that much more challenging. If you're going to get a return that's 6 to 8%, more than likely the way you're going to solve for that is by having a pretty sizable exposure to some allocation into the stock market. I'll pause for a second there and just see, Josh, any questions, or how are we doing?
I think we're okay.
Okay. Because it's hard when you're on the remote side to make sure everybody's doing okay, and I just want to check in periodically.
Yep, no problem.
And of course, I have multiple phones around me as I make fun of the phones, so I get phone calls from my personal line while I'm doing a conference call. And by the way, so therefore, if we agree that the market is where we need to be, we need to continue to educate ourselves about the market. Okay, so this goes into the basic principles of things, and again, I'm only going to hit on 3 or 4 of them today. The first one is, it's principle 1 actually in the book. It's the fact that markets on an annual basis move up and down, okay? And we're seeing that happen right now. So there's a chart in there that's on slide 7. It just shows you markets have been resilient, but history has shown that declines have not lasted. And it shows you a bar chart that shows you the year-end calendar return going back to 1980. In fact, if I know Josh and Melissa as well as I think I do, they probably have showed you this chart before. And so you do go through windows where volatility is less. So for example, last year, so volatility, when I throw that word out to you, by the way, they only call it volatility when it's down. Volatility applies when it's up and down. The historical volatility range, going back to World War II for stocks, is 16%, which tells you in a given year there's a 70% chance stocks will move up or down 16%. The historical return for stocks, just looking at the S&P going back to World War II, is about 8%. Last year, stocks returned 29%. Okay, so a sizable rate higher than it was the previous years, yet your volatility was only 12. Okay, so you see years sometimes where the market can be really good and there's not a lot of volatility. This market was really resilient. You know, we had a lot of bad news in January. I don't know if anybody remembers. You know, I believe it was an Iranian general that took a missile to his forehead. We had an impeachment. We had trade concerns, Brexit concerns, all of those things, and the market didn't care until this virus showed up. If you look at the years that are the worst, where the most volatility is, it typically coincides with recessions. And there's a pretty good chance that we are in a recession right now. Maybe it won't be the technical definition of a recession, but I'd say we're probably pretty darn close to that. My point here is the media is always going to tell you this time is different. They'll always tell you that. And what I would suggest to you is that this too shall pass. It's important to realize that when markets decline, moving out of stocks locks in losses potentially, and when the market rebounds, that may prevent you from profiting from any subsequent gains. So therefore, identify a responsible allocation to the market with managers that are really good at doing what they do, and it's probably a prudent idea to keep your allocation there. And I see Josh has that slide up now. That's a good. So the circles are showing you, for those of you who can see it, are the average, are the drawdown in any given year. The bar chart is showing you where the market actually finished. If you actually look at that, 1 out of every 4 years, roughly, finishes down. If you go to the next slide, or principle 2.
Well, Kurt, let me just jump in there real quick. And
Yeah.
Obviously, past performance doesn't guarantee future results. But if you look at a lot of the years that were substantially down, they're subsequently followed by a really good year in the markets. And, you know, we go back to 2018, although the markets only ended up year-end 6%, we had a market drawdown of 20%. And I know a lot of folks had concerns then in that fourth quarter of 2018. And although, you know, it was maybe not quite as impactful as what we're going through now, I think those concerns were new because they had come off. We all had come off several really good years in the market. But for the people who kind of stuck to their allocation, they were rewarded with a really solid 2019. And you could say the same thing with coming out of the recession in 2008. And not only that, but that was followed by, you know, one of the longest bear or bull market runs we've seen. But even going back, you know, further, you kind of see that similar pattern, and the duration of time may be a little bit different in between, but you know, we tend to see these recoveries come after the big drawbacks, and that just kind of only even more solidifies the need to stay invested, because otherwise, like you said, we're locking in the losses and we don't get to participate in that return. So
yeah, and then go back to resilience and responsibility. So if you think about how the company I've worked with my whole career, how we think about it is we're always doing our homework on which companies we feel will be the winners and will continue to be the winners, and which companies are the losers. And so if you look at the fourth quarter of 2018, we used that time as an opportunity to add to the positions of the companies that we feel confident will be the winners. And because of that, that ended up with us having a really good year performance-wise in 2019. As you go back to behavior, I remember in January of 2019, I was watching an NFL playoff game on my couch with the fireplace is on. I'm watching a football game. Kids are playing, and I heard my wife scream from the kitchen, and I couldn't imagine what could possibly be wrong. And I went in and checked on her, and she had just opened our kids' 529 statements. And I proceeded to put the 529 statements in the fireplace, because the reality is that's not the time to respond emotionally. It didn't make an awful lot of sense. So I try to phrase this from the perspective of what we see in terms of what we do at MFS versus what Josh and Melissa do, and so much of this is related again to behavior. If you go to the next point 2, historically bull markets have beaten bears. So you kind of already said this, Josh. As you look at if you look at those bad years, the average bull market last 4 years. This is going back to 1940 in this case. The average bear market lasts just over a year. And if you look at the average bull market expansion, it's about 151%, and the average bear market drawdown is about 32%. So observations I would say here. One, we did reach bear market territory already this year. I think our max drawdown was somewhere in the mid to high 20s. I think today we're at negative 17, at least through yesterday. We're not a year in. We're only a couple of months into this volatility, so history would say that it could probably go longer. I would also point out, though, if you look at bull markets, they've actually gotten longer. So this is showing you an average of 4 years, but the expansions have gotten longer. I think there's a couple of things that have to do with that going back to World War II. I think, the Fed is more heavily involved in the market today, which helps to regulate the downside of volatility. And I think companies have gotten better at managing their inventories as well because of technology. So therefore, the expansions seem to have gotten longer. So, yeah, I think you're going to say something there, Josh?
I was just going to say, just to throw out real numbers.
Yeah.
The Dow's percent off of its peak was March 23rd at just a hair over negative 37%, so down 37% off its high, with the S&P at about negative 34% off its high.
Wow.
Now
I knew it was bad. I didn't even know if that was bad.
yeah, 30 down. But it's come back. So as of now, the Dow's actually just hovering around bear market territory of negative 20.8%, with the S&P at 19. So it's definitely come back a bit, but the max drawdown last week, or I guess that was 2 weeks ago now, almost negative 40 on the Dow.
Yeah, and we'll talk towards the end about, okay, where is our bridge to recovery and stuff like that. But I would say if you look at this slide when you have a chance, you'll also see there is, we call them secular bull markets that are kind of built into these things. So you can have a recession within a secular bull market. So you saw that with the Industrial Revolution, you saw that. You've seen that with baby boomers as well. So if you look at this, you'll see from the early 40s, post-World War II, up until the mid-60s, you had a market expansion that was pretty sizable. Then you went sideways up until about the early 80s. Ronald Reagan comes in. boomers reach their peak earnings years, and you have a big expansion that takes place up until 2000. So, what is the secular reasoning for this bull market? Well, obviously, there's been an awful lot of innovation, which we already alluded to earlier in the phone call. And so as you see the rise of automated learning, machines, robotics, things like that, that could very well be kind of a second wave of an industrial revolution that's happening through technology. So there's cycles and there's longer cycles. If you go to the fourth principle, it's just going to be a little bit further in, and if you can't get there, I'll just articulate what it is. But it almost is kind of, it's kind of redundant. But we always say this, is building wealth takes time. You have to think long term. The first thing I was taught, my first day working at MFS, they actually handed me a little pamphlet called The ABCs of Investing, and it was actually in black and white, and I found it a couple of years ago, and it said on the front cover, it's not timing, it's time. And that's the reality for investors. A lot of this is time in the equity market is what helps you build your nest egg. So if you look at 1 year rolling returns for the S&P, it's positive about 75% of the time. But you start pushing out your window to 5-year, 10-year periods, 20-year periods, the number of positive periods gets higher and higher and higher. So the thing there I would say is, one, don't try to time the market, even within this most recent bout of volatility. Think about yesterday. Think if you chose to get out a week and a half or so ago, you would have missed this whole recovery. And so I say that, and I think you all know that, but then it gets rocky, and then you say, or I'll have people that are in their 70s say, well, I don't have time. I don't have the time anymore. Well, the reality is we already agreed that life expectancy is going longer, so many of you will have the time. What I would suggest to you, and this is kind of where planning and Josh and Melissa come in, is if you are somebody who's taking income and your stock portfolio has gone down more than your bond portfolio, in this kind of an environment, you probably want to give your stocks time to recover. We call it buying time in retirement, and probably think about drawing more money from the bond side of your allocation. I don't know if you guys would agree with that, Josh. It's probably on a person.
Well, actually, Kurt, it's a good thing you bring that up. A couple just quick key points on this, because we've talked about this in previous calls, and
yeah, good.
We always kind of say that first, number one, this isn't a retirement timeline, and I think a lot of times people feel like, well, I don't have 10 years, I don't even have 5 years until retirement. But this is really, I think, a whole lifetime time frame. And the way that we build the portfolios isn't just the duration of until you retire, but throughout your entire lifetime. And the next step to that is actually just hitting on what you said, which is biding time during these bear market periods, because we know the silver bullet to volatility is time. Because overall, just to not give yourself enough time, the markets do perform. And what we need to do then is take very specific measures during those down periods to give ourselves time. And actually what we have done for some clients, many clients, not all, but not all need it, but for the ones that we felt was beneficial, was we have been a little bit more specific in terms of what we're distributing right now, and we're primarily focused on distributing from fixed income right now. So in a normal market environment where we may make a pro rata distribution, which would be if you need $1,000 a month, we may take a certain percentage from every asset that you hold to send you that $1,000. Where now we're being very specific and we're just utilizing fixed income, which although depending on what it is, may be down, but certainly not down nearly as much as equities. And that gives us the opportunity to cool off, let those equities cool off a bit, and give ourselves some time to recover. And we actually haven't had to do that since 2008, so it's not something that we do with mild volatility. But certainly in this instance, we felt for certain clients that did make sense. And it's just what you said. It just gives us time to let those equities cool off and recover. So really, I think, to make a long story short, this time frame to us, I think, is one of the most important concepts. and it's really hard to remember when you do see that account drop, or you see on the news, the S&P down 37%, like we talked about. Good news is your account won't be, because it's not tracking the S&P, or I shouldn't say everybody's, but many clients, especially if they're nearing or in retirement, and we build other asset classes in there that are certainly less volatile that we can utilize in periods of time like this to give those equities time. But what that does is it insulates the equities, which expands our time horizon and gives us the opportunity to be exposed to that growth that we do need from those equities to combat things like inflation. And, I think one of the concerns, and I don't know if this is part of your presentation, but, one of the concerns that's only going to continue to get larger and larger is inflation. And fortunately, we've been in a very low inflation environment recently, but as the government continues to print money, it's only, a matter of time until that becomes more of an issue. I think relatively speaking, that's an issue that can be kind of worked on over time. So yeah, it's an important issue and it's an impactful issue, but maybe not as, I guess it's like the lesser of two evils right now. However, that only makes equity investing more important, which almost sounds like a double-edged sword, because it's like, well, equities are down so much now, but truly they may be one of the only weapons to combat inflation, or I shouldn't say one of the only, but one of the better weapons to combat inflation, which coming out of this,
certainly
looking into the future, a key weapon, absolutely, and looking into the future could very much be a really important component of even people who are retired or who are in income distribution modes, because with interest rates being low and having very little opportunity for yield and an inflationary environment, it's going to be important to be able to have equity exposure. But in order to do that, we have to have kind of these defense mechanisms within the portfolio so we can give time. And that's what we're doing.
Yeah, which actually is and I like the way you described your income process, because it's almost like almost a surgical approach today, as opposed to, and every client's different, but you take a surgical approach so the equity side of the allocation can have time to recover. And inflation is so hard to, it's funny because you almost have a tug of war between inflation and low inflation, because technology increases efficiency and things like that. So yeah, it's interesting. So you maybe go to the sixth principle here, and I'll fold this all kind of in together, because I think basically what we're saying is kind of goes back to what I said at the beginning. Is clearly we're all going to need to have an allocation, some more so than others, to the market. And number 6 principle talks about diversification, but I'm going to fold in kind of 3 things here. I would say if you're going to have exposure to the market, but you want to be prudent and responsible in your exposure, you want to think about 3 letters with what I keep in the back of your head. One is how you allocate your money. So allocate. The second is diversity, and there's some really good slides in diversity here. And the third is rebalancing. And those are probably the 3 most important letters as it relates to your investment portfolio. Allocation, Josh and I, we're younger with kids, although I think I'm a little older than Josh. But our allocation, because of that, because we have, Josh talked about it. It is not A to B. It's not. You don't invest up to retirement. It's more of an A to Z. But because of where we are, we're probably going to have a larger equity allocation today because we have a longer time horizon leading up to retirement and afterwards. But when you think about diversification, I really like some of the charts that are in here. It shows, I don't know if you've seen it presented this way, Josh, but it shows you the first 10 years. So what we're showing you is a jelly bean, we call it a jelly bean chart, but it's just the 20 years of the best and worst for different asset classes. So one of the wonderful things that's happened to investors in the past, really the past, 50 years, but the past 20 years I've been doing this, is you have more options. Kind of like life today. I mean, sometimes are there too many options? Maybe. But if in investing today, you have a lot of places you can allocate money to. It's not just stocks and bonds. It's large companies, small companies, international companies, commodities. So when you think commodities, think gold, silver, soft commodities, things like wheat and corn and things like that. You have bonds outside the U.S. But what you'll see if you look at this chart when you have a chance is from 2000 to 2009, the average portfolio. So if you look at the chart, I'm going to pull it up on my own side here, and I'll kind of read off a couple of things to you all because I can't see it on my screen. But if you look at the chart, I'm going to try to make it a little larger. Sorry.
I have the 2000 to 2009 up right now. I can.
Do you? Okay, good.
Go to
I
the
don't see it on mine, but yeah. So that's a. I have 17 presented this way, and I really like it. It's and I'm just moving through it. Okay, I'm there. So, well, one thing, if you visually, the one thing that you'll see on this that is consistent, because when I think about if we agree that emotion is what destroys wealth, we therefore want to provide a solution to you that is consistent, because consistency should lead to, look, I want my portfolio to be consistently good versus occasionally great, because occasionally great is occasionally bad, and occasionally bad typically happens at points of maximum pessimism, which is not where you want to be. So what it shows you here is a diversified portfolio is a return of 5.25% every year from 2000, or average from 2000 to 2009. What you'll see if you look at the top of it, you'll see things like REITs or real estate investment trusts and commodities did the best. The bottom, you'll see the asset classes did the worst. The place that you emotionally least wanted to touch in 2010 was large cap growth stocks. So if you go to the next slide, what you'll again see is the diversified portfolio, never at the top, never at the bottom, always in the middle. And if you go to that far right side, what you'll see is commodities drop all the way to the bottom. They're your second best asset class before. And what goes to the top? The place that you behaviorally least wanted to own, which, by the way, from a stock investing standpoint, is also still doing the best now, that would be large cap growth stocks. And your diversified portfolio return goes to 7.6% from 5% the previous decade. One point I'll make on this, so if you take diversified portfolio in the first 10 years versus the last 10 years, you're probably somewhere in the ballpark of, say, I don't know, why don't we just average it out to, say, 6.5%? The average investor over that same 20-year period returned about 3.2%. And I would just ask you why. And the reality is it's because of behavior. And so let's go back to the reality that the market is not the challenge, the market's the solution. The challenge is our behavior in it. If you push forward, Josh, to slide 22, it's the one that says diversification. Financial professional, which would be you, versus client perception, which would be maybe somebody on the call or somebody listening. We tend to benchmark ourselves to what we hear from the news on a daily basis. So we always hear about the S&P. So from 2000 to 2002, the S&P returned a little bit less than 38% to the negative. A diversified portfolio did negative 14. Josh might say to you back then, you were down, but you were down less than the S&P. As a client, you would still say, man, I'm not happy, I lost money. From 03 to 07, so you would become fearful. From 03 to 07, S&P returns 83. Diversified portfolio returns 57.5. Josh says, well, you've done well, you participated in the gains, but you say, I didn't gain as much as the S&P. That's greed. 2008 comes along, negative 37, financial crisis, diversified portfolio down 22. Josh says, you're down less than the S&P. Client says, I still lost money. Again, fear. 09 to 19, S&P does 351%. Wow, great run. Diversified portfolio does a mere 200%. Josh again says, you participated in the gains. Client says, I didn't gain as much as the S&P. But when you look back on that 20-year number, you see the S&P does 197. A diversified portfolio does 206. Josh says diversification works. You say, wow, diversification works. I'd also point out to you a diversified portfolio over that same time period. Not only did it out-return the S&P, it did so with less risk. It was more consistent and more reliable. And that's really what this is about. And we could go through different slides, but I think that's a good amount of information right there. I'll pause it for a second and see if I'm missing anything, Josh, and then maybe we can wrap up with a couple observations on the marketplace here.
Yeah, that's great. And actually, this is a really good slide.
That's a great slide. We should have just done the whole presentation on this.
Yeah, well, I think one thing that was very difficult for investors in general, and this isn't like a client advisor type of thing, but I just mean investors in general, is that 2009 to